Okay, so we are recording. Yes, don't forget to record. Thank you, Mr. Mangali. This time I remembered on my own, but please keep on reminding me. So welcome to the Tuto venue, those of you sitting here in front of me, and those of you at home underneath your blankets and your hot chocolate. Welcome to you guys as well. Good, so today we are looking at IAS 16, and I asked you to watch the prep video, short little video on which I just put the theory for today's lecture so that we can focus more on the calculations on that. So I just want to quickly run through that. I told you that there are just two things in IAS 16 that you should, with regard to IAS 16 for FRK 300 that you should know. So having said that, this means that we are actually, I am going to use those dreaded two words, the two words that students hate the most, and that is assumed knowledge. Okay, do you like those words? Okay, so I am assuming that you are comfortable with IAS 16. I know that Mrs. Janssen van Rensburg taught you that last year, and I know that she's excellent at what she does. So I am comfortable that you know what goes on in IAS 16, or you should know. I am assuming with a warm fuzzy feeling that you are on top of IAS 16 with regard to your FRK 201 work. So all we are adding in FRK 300 is, first of all, we are going to look at the revaluation of land. In FRK 300, we will only revalue land, and we'll only revalue it upward. And then you'll see when we do that, we will have capital gains tax consequences that we put into our deferred tax. Okay, we are going to put in a provision for that deferred tax at the capital gains tax rate. And we saw that that comes from paragraph 51 and 51B. Specifically, paragraph 51 says that we should use the tax. You should use the tax rate. What is 51? So 51B says that for a non-depreciable asset measured using the revaluation model. So that's land on the revaluation model. We are going to measure the deferred tax according to the way that this asset is going to be recovered. So up to now, what we've done when we had land on a cost model, we actually said we are going to, we measured deferred tax based on as if we're going to recover through use. However, now we're saying the moment we revalue, we measure deferred tax as if we are going to sell that asset, okay, on the land. So that means that we are going to have to use our capital gains tax rate to measure that deferred tax. Good. Okay, and then the second thing is just a disclosure, a disclosure matter, and that is that, remember we said when we started with IAS 12, we said that the tax consequences follow the transaction, and that applies to revaluations as well. So the tax consequence, if we have a revaluation, that revaluation is going to go into OCI. So the tax consequences on that revaluation will also go to OCI. Okay, and that's what paragraph 61A tells us. Good. And then I showed you what the journals will look like. So important note, these journals, when we do this revaluation, so think about it now, think about your deferred tax calc. So when we do this revaluation, we originally had the land in our deferred tax calc at the original cost, remember? And then we said that the tax base of that land will be, what will be the tax base of the land? What did we do up to now? Tax base would be? Okay, there's a competition between the venue group and the collaborate group. Let's see. 0, 0, 0, 0. Oh, the collaborate group is winning. Okay, so our tax base for the land, for land held at under the cost model will be 0 because we will have no future deductions. Okay, so and then what did we do with our deferred tax? What happened to our deferred tax? Quickly, venue. It was exempt. Yes. Oh, they beat you there. Sorry, they beat you. Okay, so yes, our tax base will be 0. But we will have the carrying amount less the tax base will give us a temporary difference, but it will be exempt for deferred tax purposes. Now, the moment we revalue, we are now actually we are karringing. What is karring in English? Messing with the carrying amount of the land, because we are increasing the land's carrying amount. So can you see that in your deferred tax? Can you see that your land carrying amount is getting bigger? Okay. And now immediately when we do that and we revalue a non-depreciable asset, the standard tells IAS 12 paragraph 51b tells us now we have to assume that we are going to recover the land through sale. Okay. So that means that when we sell the land now, what will we be allowed to deduct? Say we are able to sell the land at that revalued amount. What amount will we be able to deduct for tax purposes against those proceeds from the sale? Okay, think capital gains tax. What do we deduct? Think FRK, BEL 200, what do we deduct? The base cost. Online group is winning. Okay, 2 for the online group, 1 for the venue group. Cool. I should actually keep score. Wish I had 1 and 2. Okay. That is very close, especially in COVID. Okay. Good. Let's carry on. Okay. So that's what's going to happen on deferred tax. We'll look at that now on today's class example. So here we do, and that happens, so here we do our journal for the revaluation. So this is on the date of the reval. We do this journal, debit the land, credit the revaluation surplus in OCI. And now we have to, so this journal you know from 201. And this is our additional journal that we now do in 300. So what do we do now? We say, okay, now we have to accrue for the tax consequences. So what we do now is we say, okay, this revaluation surplus over here was the gross amount, but remember, equity is always after tax. Okay, you know that in your splokkie, you've got your profit before tax, then we deduct the tax, income tax expense, and the amount net of tax is what rolls up into retained earnings at the end of the year. Okay, so equity is always net of tax. And we know that this revaluation surplus is sitting in OCI now, but at the end of the year when we do our closing journals, it's going to roll up into our statement of changes in equity, our reval column, and it's going to sit there, the amount net of tax. So now we have to accrue for that tax. So what we do is we have another account where we say revaluation surplus, deferred tax, OCI. Okay, remember we said the tax follows the transaction. You'll see on the face of the splokkie in your notes where I gave you that example, we have our revaluation of land, but we split it up between the gross amount and the deferred tax on that. Good, so these two amounts together, this amount and this amount, the net of that is what rolls up into revaluation surplus. Okay. Good. Okay, so we have someone in the online group who's going to keep score for us. Don't know if we can trust you, Moses. So maybe someone in this venue should also keep score. Okay, because you will be a bit partial to the online group. Good. Oh, I've got it here. So there's our splokkie. So this is our splokkie. And here you'll see there's our other comprehensive income. We've got our revaluation surplus, which we split into these two amounts. So we'll have our gross revaluation over here, and then we'll have the tax there, giving us the net amount that's going to roll up into equity. Good. Okay, and then we say that when we sell that asset later on, obviously we have to transfer the revaluation surplus to retained earnings, and we'll do that just what we have in revaluation surplus equity will be the net amount, and that's going to be the amount that's just transferred. We don't show the tax on that again, okay, because we've already accrued for the tax. Good. So if you just go back to the journal, so remember when we did our deferred tax calc, I told you that we do that calc, temporary differences, deferred tax, and we put in all our assets and liabilities, all their tax bases, calculate the temporary differences, calculate the deferred tax, and then we calculate a total. And we only account for, so we said that in our deferred tax general ledger, general ledger account, deferred tax in the SFP, we said that we will have an opening balance sitting there in our deferred tax account, and we won't touch that balance at all throughout the year, up until at the end of the year when we've calculated our closing balance, and then we say, okay, we want our closing balance to be this amount, so therefore we need a journal of whatever it is that we need. Okay, remember we said that. Good. Now that is still true, except for one exception. Okay, there's only one exception. So there's only one transaction that when that transaction happens, we account for the deferred tax on that transaction. Remember someone, I can't remember, I was so nasty to someone yesterday when I said that's a stupid question. There are no such thing as a stupid question. I'm so sorry that I said that. I said that would be silly to do it to do the journals per asset. Remember that? So so there's only one exception, and that is the moment we have a revaluation. Because can you see that the moment we have this revaluation, we have our opening balance sitting over there at the beginning of the year. Now, usually a revaluation also happens at the beginning of the year. So when this revaluation happens, we account for the tax on that revaluation. So only one transaction where we actually separately account for the deferred tax on that. So what's going to happen here is we are going to this entry to deferred tax, we are going to actually put in that amount. The other leg will be revaluation surplus OCI. Then at the end of the year, we do our calc where we calculate our closing balance, which is going to include, we are going to have our land in here at the revalued amount with our base cost over here, giving us a temporary difference, which we are going to calculate the deferred tax using the CGT rate. So this journal that I did over here will be included in my closing balance. So then I'm going to say, okay, I still want this amount over here to be my closing balance. So that amount must be my closing balance. So what journal do I now need to that should go to my income tax expense in the P&L? Okay, so only one exception. Only deferred tax we only show when the transaction happens on the date that we revalue. Okay, good. So now I'm now going to move to your notes. So we are now going to look at your notes. In your notes, you'll see there's a detailed discussion of paragraph 51 and paragraph 51B. You'll see that there are some questions that you can ask yourself to make sure that you are on top of FRK 201 I16 work. And then we've got 4 examples in those notes. So example 1, 2, and 3 deals with only FRK 201 work. So no tax on that. It shows the normal, what happens with the normal revaluation. Then it shows, okay, what happens when we upwards revaluation in year 1, and then a few years later we have a downwards revaluation. And you know what happens there. We first go and clean out the revaluation surplus, and then we go into our P&L expense. Okay, remember now for FRK 300, we will only, when we test the tax consequences, we will only revalue upwards. However, watch out, because you know that in your year test 1, for example, now your year test 1, you've got all those revision topics that you have to study. Okay, your FRK 201 revision topics. So, for example, in year test 1, we might give you a revaluation scenario where we don't ask for the tax, but you must still be able to do that. So I'm not saying downward revaluations are excluded for FRK 300 purposes. I am only saying that we will not test the tax consequences of downward revaluations. Do you get that? Cool. Okay, they are talking nonsense here on the online group. Shame, Mr. Groenewald, I was nasty to him, so sorry. He says he will never recover. I'm really sorry about that. To the HOD. Okay, what occurs when an asset is on the revaluation model, but its accounting depreciation offset against its revalue? Okay, so remember now, we only revalue land. So we are not going to revalue a depreciable asset. That's actually something that a few years ago that SAICA excluded from the syllabus. So I know you did it in FRK 201 if I remember correctly, but it's not included in the SAICA syllabus anymore. So therefore we won't revalue a depreciable asset. We will only revalue land. Good. There might be other non-depreciable assets that I can't think of now, but anyway. Okay. Good. Okay, so example 1 to 3, FRK 201 revision. We are now going to look at example 4. So I always feel like a dominee when I say this, but please take your notes and open them to IAS 12, verse example 4. And then we will work through that example. Okay. Okay, so on the online group, have you opened your notes, and are you with, you have class example 4 in front of you? Okay. Ooh. Do we not have class example 4 with us? Okay, so the notes are all there on ClickUp. We tried to load it about a week before the lecture. So this was a little bit late. I think I only loaded it on Thursday, but still there was enough time over the weekend to get it printed and ready and whatever. Good, so I'm going to, I don't have it on the screen, but I have the example with me, so I'm going to just read through the example. But you'll be able to follow even if you don't have the example before you, because it's actually straightforward. Good. There we go. Okay, so they tell us that Jupiter Limited purchased land and factory buildings for 1,190,000, 1.19 million on the 1st of January X1. So first of all, for this, in this example, you'll see that we have to do the transactions for the 2 years, X1 and X2. Okay, 31 December X1 and 31 December X2. So they tell us that on the 1st of January X1, we purchased land and buildings for 1.19 million. And of this total amount, 190 was attributable to the land, and the rest obviously to the buildings. So our land was 190,000, and our buildings were therefore R1 million. That was our cost when we purchased the land and buildings. Okay, it's classified as owner occupied and was available for use as intended by management immediately. Factory buildings are accounted for on the cost model. So we use cost model to account for factory buildings, and are depreciated on a straight line basis, an estimated useful life of 25 years. So the buildings will be depreciated over 25 years. An insignificant residual value. Assume that SARS allows a tax allowance in respect of the factory buildings of 5% per annum. So this is accounting, and for tax we get a 5% per annum deduction. Okay, it's not, they don't tell us whether it's prorated or not, but it doesn't matter because I anyway have that asset for a full year. Okay, so if they tell us that it's not prorated and I purchase my asset in the middle of the year, I will still get a full year's tax deduction. That's what prorated means. Good. But in this case, it doesn't matter because anyway, I purchase it at the beginning of the year. Not a portion. They do say not a portion, but they didn't have to. But anyway, land is accounted for on the revaluation model, And the revaluation surplus arising on the revaluation of land only realizes on the sale of the land. Obviously, can't use. So the land was revalued for the first time on the 1st of January X2 to its fair value of 250,000. So on the 1st of January X2, our land was revalued to 250,000. Okay, reporting date 31 December. Tax rate for companies is 28%. Okay, and then they tell us that there are no other non-taxable or non-deductible items or other temporary differences other than those arising from the information above. Profit before tax, after taking all of the above information into account, amounted to 850,000 for X1. So that's my accounting profit. And 980,000 for year 2. Okay, so that's the scenario. Now they tell us to, first of all, prepare the general journal entries of, oh, no, it's Saturn Limited. It should be Jupiter. What happened with Saturn? Never mind. Prepare the general journal entries of Jupiter Limited in respect of the land and factory buildings for the years ended 31 December X1 and X2 in accordance with IFRS. Closing journal entries not required. Journal entries must be dated. Journal narrations are not required. Good. Although we always say, or not always, sometimes we don't. So watch out. That note information at the bottom of your required. Look me in the eye. That note information is very important. Okay, don't skip that note information because sometimes we might not say that journal narrations, or yeah, we say journal narrations are required. But if we don't say that, then you still have to give journal narrations. Journal narrations are actually part of a journal. So what's actually going to happen in ITC? In ITC, they force you have to write journal narrations. So most of the time, pre-grad, we don't ask for those narrations because it takes up time, and we want to rather see what it is, you know, if you know the work. But the thing is with ITC, they want those narrations because it just helps the markers to understand what it is that you're trying to accomplish with those journals. So just watch out for that. Yeah, I'm asking you that they are required. You have to do them. Good. And then we also have to do the splocky and the statement of changes in equity. And then they ask us for some notes as well in C. If I remember correctly. Yes. Good. So we are going to start with the journals. So before we do those journals, we first have to do some calculations. Good. I have to do that here. Okay. So we start off our calculations for 20X1. We have our original cost for the buildings. Obviously for land, we don't have depreciation or anything, so we don't have to calculate anything there. But for the factory buildings, we start off with our original cost. Then we calculate our depreciation, so that will be the 1 million rand divided by 25 years, giving us our depreciation for the year 40,000. And then the tax allowance is the 1 million rand multiplied by 5%. So that's the tax allowance. See, I'm calculating my accounting and my tax so long. At the end of the year. Okay, so we are going to have to do a journal to account for the original purchase of the land and buildings. We are going to have to do a journal for the depreciation. And then we are going to have to calculate our current tax, to do a journal for the current tax. And we are going to have to calculate our deferred tax, to do the journal for our deferred tax. Good. So, the tax journals will be the current tax journal and the deferred tax journal that we have to do. I hope I have it in the right order now. Income tax expense. Oh yes, the numbers I see is a little bit wrong for journal 4 and 5, but it's right. Good. Okay, so we have to do those journals. So let's go and calculate what our current tax expense should be and what our deferred tax journal then should be. Good, so current tax for X1, they gave us our profit at the beginning of the year. And then we have to obviously add back the depreciation and deduct the tax allowance, giving us our taxable income, multiply that by 28%, gives us our income tax expense. So the income tax expense is going to be that journal number 4 that we have to do. Oh, no, it's going to be journal number 3. What did I say here? Yeah. The numbering on your page is wrong, you'll see. But anyway, this is going to be our journal number 3, which we're going to do. We have to debit the income tax expense and credit our income tax payable. And then our deferred tax, we start off, we didn't have any other assets or anything, so we start off with an opening balance of 0. So our opening balance at the beginning of the year would be 0. And the reason why I'm doing this, you'll see the deferred tax calc here. On the 1st of January, we don't do a deferred tax calc at the beginning of the year. The reason why I'm showing you this is that this was the original purchase date. So I'm showing you here that for land, the temporary difference arose at initial recognition. So this is my initial recognition date. Temporary difference arose at initial recognition date. It was not part of a business combination. And it, what's the other one? Oh, at the date of purchase, initial recognition, it did not affect the county profit or tax profit, so therefore it's exempt. Whereas with the buildings, on the date of the initial recognition, our tax base and carrying amount would be the same, so therefore it will not be exempt. So this is just for illustration purposes. You don't have to do that in a question. So this is just to illustrate our paragraph, whatever exemption, I can't remember what paragraph, 24 I think. Yes. Good, so what we have to do is we have to do our deferred tax calc at the end of the year. So here we have our carrying amount for land. The tax base will again be 0 because the economic benefits that I'm going to get from the land will be taxable. So the tax base will be the future deductions, which is 0, giving me a taxable temporary difference, but it is exempt. Good. Then for buildings, we calculated what our carrying amount was at the end of the year. We calculated that over here. So our carrying amount was 960,000. Our tax base we calculated is 950,000. So therefore, put that in. We've got a taxable temporary difference multiplied by 28%, and that gives us then our deferred tax. Okay. So here, just some exam tips. You don't have to show a calculation. You don't have to do a calculation where 10,000 multiplied by 28%. So that's A and that's A. You don't have to do that. But you have to show that you did multiply by 28%. So we will give you a mark for having that 28% at the top of this column. So make sure you put that in. Remember, a marker should not have to pick up a calculator to see what it is that you calculated. We should be able to see from your calcs what you got. Yes? Okay, so for the online group, she's asking, is it necessary in a test to say if the reference, the paragraph reference, yes. So no, it isn't. So you only have to write that it's exempt. Okay. So you don't have to give the paragraph reference. Oh, there is the paragraph reference, paragraph 15. Or did I say 24? Never mind. Good. Okay, so you only have to you only have to say exempt. Okay. So obviously, now we have to do a journal. So that will be our fourth journal that we'd have to do for the movement in deferred tax. So we've now calculated what our closing balance is. So this is our closing balance. Our opening balance was 0. So we have to, in our deferred tax calc, in the SFP, we have an opening balance of 0. We want our closing balance to be a credit 2,800. So that's the brought down balance. no, pulled down, carried forward, or whatever, should go over there. That means we need a journal on this side of 2,800, and the other leg will go to income tax expense. So that's our fourth journal. Okay, Mr. Mangali, you're jumping the gun. He's asking, so we must account for deferred tax at year end after taking revaluation of assets or possible changes in estimates into account. And estimates into account, sorry. Spaces, Mr. Mangali. Spaces make all the difference. Punctuation can save lives. Okay, so if we say, let's eat, Grandpa. Okay, that's fine. Let's go and eat, Grandpa. However, if you take the punctuation out, Grandpa's days are numbered. Okay, so punctuation saves lives. Okay. Okay, so let's look at our journals. Oh man. Okay. So our journals are these journals are so straightforward. I'm quickly going to do it. We've already discussed all of it. So the first journal we do is the initial recognition of the journal. So we'll say land. Now you're going to see my bad handwriting. Always remember to show which component of the financial statements are affected by the journal. Okay, purchase price was 190,000. Our factory buildings, also SFP. Don't write buildings. That you will be you won't get the marks for that. It will be 1 million, and then our bank SFP 1190. My dad always used to tell me, do what I tell you, not what I did. So the same thing goes here. Do what I tell you to write. Write up factory buildings. Don't just write bill. Okay. Good. So that's the original purchase on the date of purchase. Then our next journal, we have to go to the end of the year. So journal 2 is going to be our depreciation. So we debit our depreciation in the P&L with 40,000, and we credit our accumulated depreciation in the SFP with 40,000. And we reference this to our calculations. So we say we reference this to Calc 1. And it makes it easier for the market to go and mark it. Okay, on that note, this is not a cross-reference. That is not a cross-reference. I'm already married. I don't want to see any hearts on your papers, please. Okay, and this is the sign of the devil. So that is also not a cross-reference. Don't use it. Good. Cross-reference is a proper calculation, whatever. Or even if you just say a little 1 as a cross-reference for your calcs. Good. Okay. So next, the next journal that we do, so this was journal 2. So the next journal, and then obviously we'll have a little story about why we do that journal. Number 4 will be our income tax expense. So we'll have our income tax expense, also P&L. And we calculated that that is going to be 235,200. And the other leg will go to my current tax payable. Payable SFP 235,200. Good. And then journal 4 was our deferred tax. We will also say income tax expense, P&L, credit deferred tax, SFP, and the amount was 2,800. Okay, so that 2,800 now comes from, it's this 2,800 amount that we put into our GL account to make it our balance. Okay, so everyone happy with that? With X1. Straightforward, nothing weird. Now we get to Mr. Mangali's question regarding the revaluation. Let's just quickly check We had to watch the example. The deferred tax calc for revalued land had a tax base one from what I understand. Tax of land would be 0. I'm confused. Why is it different? Okay, Ms. Lewis, let's do the revaluation, and then we will see why we sometimes have our tax base at 0, and sometimes we have our tax base as the base cost. Okay, we'll get to that just now. Okay, so they're answering each other. That's wonderful. You're making my work much easier. Any questions on the floor? Questions here in the venue? My goodness. We need some spontaneous dancing or something to wake you guys up. Okay, I've been told that you are going to get excited and it's going to go better, but you were so quiet. Okay. Yes, some dancing. Ms. Marie, you can dance around in your room. Good. So next, now we go to year 2. Oh, there's a question. Yay, we've got a question. Okay, question.
The revaluation service tax automatically will just allow us to get revaluation services.
Okay, so the question is, the deferred tax on a revaluation, is that a separate column in the statement of changes in equity? Is that what you're asking? No, it isn't. In our statement of changes in equity, we only have revaluation surplus, and we only have the net of tax amounts in there. Okay, but we'll look at that. Good, so now we go to 20x2. Can you combine journals 3 and 4? You can. You can do that. But remember, you are going to have to disclose the 235,200 and the 2,800 separately in your income tax expense note. But you are welcome to combine that. Okay. Good. So now we go to year 2. So we've already calculated our carrying amount and our tax base for year 1. Now we just have our depreciation and our tax allowance again, giving us our carrying amounts and tax base for year 2. Good. Got that. Nothing weird or strange there. In our current, we'll get to the revaluation just now. So this is for the building. Yeah, that's just for the building. So we'll get to the revaluation of the land now. So in our current tax calc, obviously land is not going to affect our current tax calc. We have our, for year 2, they gave us our profit before tax. Add back the depreciation, deduct the tax allowance, and we get our taxable income multiplied by 28%. That will be my income tax expense for current tax, the current year. Okay, so I'm going to do a journal for my depreciation. I'm going to have to do a journal for my current tax. And now we get to our deferred tax. But wait, I still want to show you. Oh man, did I miss that now? Okay, yes, good. Now our deferred tax for X2. So what now? Remember what happened now is we had our land had a carrying amount of 190,000 for X1, and then for X2 we revalued it to 250,000. Good. So when we now do our deferred tax calc for X2, the carrying amount of land will, remember our opening balance is 2,800. Carrying amount of land will be the revalued amount of 250,000. Now in year 1, our carrying amount was 190,000. We said that we have no tax deductions because we are going to use the land, and while we are using the land, we will not get any wear and tear on that land. So therefore, we had a temporary difference, which we said was exempt because it arose at initial recognition. At initial recognition, wasn't a business transaction, didn't affect accounting or tax profit at initial recognition. Okay. You are tracking my aandag off. Stop it with your chats here in the chat about music. Okay, stop that. You can chat about that afterwards, because now I have to read about Black Sabbath and Slipknot, and that just upsets me. Good. So concentrate. Sorry guys, you are all concentrating. I know. At this moment, The venue group is my favorite. Good. Okay, so this is what we had in X1. We said we're going to use the land. Tax deductions while we are using the land will be 0. And then we said, okay, but it must be exempt. Got that? You remember that? Now, what do we do now with after the revaluation? Remember that paragraph 51B says we have to calculate the deferred tax on a non-depreciable asset that has been revalued as if the manner of recovery of that asset is going to be through sale. So here we were saying, okay, we're going to recover it through use. Now we have to do our calcs as if we're going to recover it through sale. So when we sell the land now for 250,000, we are going to get a tax deduction. Do you agree with that? Yes. What will be our tax deduction then? What will be our tax base then? The base cost of 190,000. Okay, so that means we now have a taxable temporary difference of 60,000. But watch out. We are not going to take this 60,000 and multiply it by 28% only. We also have to multiply it by 80%. And that gives us then our deferred tax balance relating to the land of 13,440. Okay, and here you will have a little calc cross-reference to show how you calculated that amount, because obviously you didn't just use the 28%. So you'll say 28% times 80% equals 13,445. Think a bit how difficult it will be to work through homework questions if we didn't cross-reference our calculations in the homework questions. I think I'm going to do that for IFRS 16, take out all the cross-references for calculations and see how you do. And now you expect me to mark your tests without cross-referencing to calcs. Okay. And on that, something important, I don't know if we've told you before, is you know that in FRK 300, if you don't use your calcs, you get 0. Oh, I see everyone's heads picked up. Okay, so if we ask you for a splockie, we mark the splockie. If there are cross-references in there to a calc, we'll go and look at the calc. But if there aren't, and we see calculations that you did not use, you get 0 for those calcs. Okay, that's how it works in CTA. That's how it's going to work in ITC. So that's why we do it now already. Good. So just watch out. Okay, then for buildings, our carrying amount we calculate as 920,000. Our tax base was 900,000, and giving us a taxable temporary difference of 20,000. Now we just multiply by 28%, 56,000, giving us a total of 19,040 closing balance. So there's our opening balance, there's our closing balance. Okay. Now look at what happens in our deferred tax account. So in our deferred tax account, there's our deferred tax SFP account. We had an opening balance of a liability from X1, 2,800. On the day of the revaluation, we account for the tax on that revaluation. So on the day of the revaluation, we are going to do a journal. Let's see if I've got, no, I haven't got the journal, but I'll show it to you here. The journal that we are going to do is, just get it. We are going to say debit land in the SFP with 60,000. Credit the revaluation surplus in OCI with a 60,000. That's the gross tax, or the gross revaluation. Then we go and account for the tax. So then we go and we say, okay, debit the revaluation surplus deferred tax in OCI with 13,440. So that's the 60,000 times 28% times 80% gives us the 13,440. And we are going to credit our yeah, deferred tax. Deferred tax SFP with 13440. So this happens, oh, it's the wrong date. Yes. Is that what you wanted to say?
Yeah.
Cool. Thank you. I realized it. So on the 1st of January 20X1, when we do our revaluation, that is going to be our journal that we have to do. So this leg, almost said a bad word. This leg of the journal is what's going to go to my deferred tax account on the date of the transaction. So remember we said this is the exception to the rule. This is the only transaction we account for the deferred tax on the date of the transaction or the date of the entry. So if we go back here, so what we have here is in our deferred tax account on the 1st of January X2, we are going to have a journal for that 13440 credit to deferred tax. Okay, we've calculated what we want our closing balance to be. It's also a liability still. So therefore, we want to start next year with this liability, 19,040. So that's the brought down, carried forward will be 19,040. So we need a journal in this account to the value of 2,800. Is it right? 16, 17. Oh. Okay, so this will now happen on the 31st of December X2. And that, the debit is going to go to my income tax expense, P&L. Got that? You see that? Okay, so it's the only journals, okay, I've shown you the revaluation journal already on the 1st of Jan X2. The depreciation journal is fine, journal 7, journal 8, the income tax expense you should be able to do. And then the only journal that I'm going to just quickly do is that last journal, which is as we did the T accounts where we said income tax expense in P&L for the 2,800 and we credited our deferred tax SFP 2,800. Okay, so those are all our journals for the revaluation. How are you feeling about that? Venue? Got that? Following that? Okay, cool. So if we look at our T account here at the top, so this is what we have done. This is what we have done up to now. Up to now, we only did that. We had our opening balance, we had our closing balance, and we did a journal for the movement. But now we've got that one exception where we do have the revaluation, where we account for that deferred tax already in our on the date of the transaction. And you'll also see that this 13,440, the journal that I did over here, is included in my closing balance of 19,040. Okay, which is what it should be. So the 2,800 effectively is only the movement from this 2,800 to the 5,600. Okay, that's what goes to P&L because it originates from temporary differences. On the difference between depreciation and wear and tear allowances. Okay, let's quickly check the group for some questions. Why not on the 1st of January? Thank you, I fixed that. Are we going to count for the 20% as with other items of PPE through P&L? You have the exempt portion of capital profit as a non-taxable income. Okay, but remember now, okay, so Mr. Grobler is asking that 20%, will that be a non-taxable income? But remember that 20%, if you look at the journal now for that, the revaluation and the tax, can you see that nothing here went to P&L? Okay, so nothing of, at the date of the revaluation, my accounting profit was not affected. So I don't have to put anything in my current tax calc for this revaluation because accounting profit before tax was not affected. Okay, but we'll see later when we sell that asset, then things get interesting. Okay. I think only myself. Yeah, thank you, Ms. Pretorius. Will the tax base remain 190,000 in the next year, even if we don't have a revaluation next year? Yes. So what's going to happen now is our tax base over here will stay 190,000 up until the date when we sell that asset and the asset is gone. Okay, because the base cost is not going to change. The base cost is going to stay 190,000. If we revalue again, then obviously this amount is going to go up, and my deferred tax cumulative balance, the deferred tax balance in the SFP is going to grow. But when I do my journal for that revaluation with the amount that this carrying amount is going to go up with that little piece of the revaluation, the tax on that is going to be a journal, and that's going to increase that 13,440 to the higher amount. Okay. Is the 80% CGT because the land is revalued in that year? Yes. Cool. Okay, so because the moment we revalue, we now have a taxable temporary difference, but it's going to be taxed at the CGT rate. Okay, so I just want to quickly show you the Splocky. I don't know, why do we start with Jupiter and then do you have Jupiter? Do you also have Jupiter Saturn? Okay, that's quite important to have the right company name. Okay, so sorry about that. Anyway, we start with a Splocky. So you'll see here, here's our income tax expense. So this was our current tax plus our deferred tax movement, and this is now for X2. So we're now looking at just at a Splocky for X2. On that, quickly, another point important, look into my eye. When we have, like I said, that note information at the bottom of the required is very important. So you know that according to IAS 1, we have to have two Splockies. We have to have a 20x2 and a 20x1 Splocky. Okay, that's actually what we will have to have comparative years. So read this, the note information. If we tell you that we can ignore the comparative year, then you do that. If we don't say anything, remember a Splocky actually has comparative information as well as an SFP. Good. Okay, so that's there. And then here's our revaluation of land, the gross amount less the income tax expense. Okay, cool. Statement of changes in equity, there's just the net amount, 46560, which comes into my revaluation surplus through OCI, okay, through comprehensive income. And then income tax expense, there's my current tax for the current year, my deferred tax, and you'll see that we don't need a reconciliation because if I take my accounting profit and I multiply that by 28%, I get the same amount than my total for my part 1 of my income tax expense note. Total income tax expense. Good, and that's also the reason because I could account for everything. No, there's nothing that I couldn't fix with deferred tax. Okay, and I also have to tell them what is the rate that's used. Deferred tax note, I just go to my deferred tax calc and I say this 5,600 comes from accelerated wear and tear. So the wear and tear is quicker than the depreciation. So that's why I have a liability. And then I've got my revaluation of land, which gives me that 1344. Okay, everyone happy with that? Will that surplus realize to retained earnings at sale of the land? Yes. Any other questions? Any further questions in the venue? Okay, so now things get interesting. Now we go to part D. Part D of this example tells us that we now have to assume that the land and factory buildings were sold on the 1st of January X3. So in the next year, first day of the next year, the land and buildings were sold for 1.4 million cash, and that 280,000 of the proceeds was attributable to the land. So we sold it for the actual carrying amount, the revalued amount that we did last year. Am I right? Yes, 204. No, we sold it for 280, for a little bit higher. Okay. Okay, what's with that? The profit before tax for the year ended 31 December X3 amounted to 1.2 million after taking the effect of the land and factory buildings into account. And we have to again do the journal entries and then extract of the splokkie and the tax expense note. Okay, so what happens in X3 now? The beginning on the first day of 20X3, here we had our carrying amount and our tax base that we calculated just now. And this 920,000, and this is now for the factory building only, consists of the original cost and the accumulated depreciation. Then I sell it for 1.12 million. So that means for the buildings, I have a profit, accounting profit of 200,000. But for tax purposes, we have the recoupment of 100,000. This does not look right. Because the proceeds should be the same also. Just quickly double check that. Oh, okay. So this is the proceeds on the sale, the total proceeds on the sale, yes. So accounting profit will be the full 200,000 difference between the proceeds and the carrying amount. However, for tax purposes, to calculate our recoupment, it will so the portion that will be is now is going to go to my income tax, current tax calculation as a recoupment will be the difference between my tax base and my original cost. Okay, so this is the 100,000 is then my recoupment. Good. So we had. See if I can quickly just open a blank page. So for the buildings, we have a where is it now? Okay, so for the buildings, our cost price. Our cost price was, our original cost was 1 million. Our carrying amount on the date of sale was 920,000. And my selling price was 1,120,000. Okay, so that's for accounting. Now for tax purposes, obviously the selling price stays the same. The selling price stays 1.12 million. The cost is the same, 100,000 or 1 million, sorry. But now my tax base will be 900,000. Okay. So what happens now? Ooh, going to use a pretty pen. So what happens now is for accounting purposes, I'm going to show a profit on the sale, which is going to be the difference between, and this is now, remember that this is for the building. Profit on the sale is going to be the difference between my carrying amount and my selling price. So the full amount over here, the full difference is going to go to P&L. Agree? Do you agree with that when I sell it? Good. But for tax purposes, what's happening here is, so for accounting purposes, we said the full difference is going to be included in P&L. Now for tax purposes, we are also going to be taxed on the full difference between the 900,000 and the 1.12 million. However, we are going to be taxed at different rates. Okay? Because the difference between the cost and the tax base is going to be the recoupment, which we are going to have to add back in our current tax calc, and we are going to be taxed on that at 28%. However, the difference between my selling price and my original cost is going to be my capital gain. It's going to be a capital gain. So I'm going to be taxed on that portion at 28% times 80%. Okay, so can you see that we are going to have a problem in our tax calc? Because for accounting purposes, 100% of that profit is included in P&L, but for tax purposes, we are only going to be taxed. We are also going to be taxed on the 100%, but we are going to be taxed on the capital gain. We are going to be taxed at a different rate than we would be for the recoupment. Okay, this is 28%. I can't remember what 28 times 80 is. 22.4, I think. I'm going to just write it very ugly so that you can't see what it is. Good. We got that. Cool. Okay, so that's for the factory building then. So that's for the factory building. And then for the land, what happens with the land? So here we have our land. We had an original cost of 1.9 million. Then we revalued to 250,000 and we sold for 280,000. Okay. So when we now sell that asset, our accounting profit is going to be, so the full amount from the original cost to the selling price is going to be my capital gain, or is actually a capital gain. Okay. However, remember that we've actually already accounted for the 60,000 through revaluation in 20x2, which means that my accounting profit is going to be in 20x3, the profit on the sale of the land is only going to be the 30,000, the difference between the carrying amount and the selling price. Okay, can you see the difference here between land and buildings? For the building, what we had our selling price was here at the top, but then our carrying amount was lower than our original cost. Now, because we only revalue upwards, we are not going to have that situation for land. For land, you'll see that your cost is now the lowest value, carrying amount a little bit higher, selling price even higher. Okay, so we are going to be, for tax purposes, we are going to be taxed on the full capital gain, but only 80% of that. And included in my accounting profit for the year, we are only going to have that 30,000. Okay. Oh, there's my building picture. Thought that I had it. So if we now do our current tax calculation for 20x3, then it's going to look as follows. Just get it. You also have it, but anyway. So the profit before tax for the year, for the 20x3 year, they gave to us as 1.2 million. Okay. However, included in that 1.2 million, we have our total profit, or included that 1.2 million profit for the year, we have got the gain on the sale of the land of 30,000. So 30,000 is included in that 1.2 million. And then the sale of the building gave us then a 200,000 profit. Am I right? Please audit me. Okay, so now when we do our current tax calc now, remember remember that we said the moment our temporary differences over here are situations where over time my accounting is actually the same, is going to be the same as my tax. That's what a temporary difference is. So let's think about this capital gain now that I made on the sale of the land and buildings. Are we ever going to have a situation where tax and accounting is going to be the same for that capital gain? Because think about it, for accounting purposes, we include 100%. But for tax purposes, we will only be taxed on 80%. Are we ever going to get to, 10 years from now, get to a situation where SARS says, oh, you were only taxed on 80%, now we're going to tax you on the remaining 20%? No. Okay. So therefore, this capital gain is going to cause problems for us in our tax rate reconciliation because it's not temporary differences. The tax and the accounting will never be the same. So therefore, we've got this non-deductible and non-taxable items over here regarding this capital gain. Okay, so the capital gain on the sale of land, remember that we have an exempt portion, the 20% exempt portion. So what you can do now, let's just go back to this calculation for the land. What we can do is we can go and say, okay, let's first of all get rid of the accounting profit, okay, and then we put in the tax treatment. However, we have to remember that we have to split it between our temporary differences and our non-deductible items. So what I'm just going to do for sale of land, I'm going to say, okay, remember, included in this profit of 1.2 million is the 30,000 profit for land. However, 20% of that is exempt of tax. So therefore, capital sale on land, that the difference between the 280,000 and the 250,000, so that was my accounting profit for the year, the 30,000. Okay, so 20% of that is exempt. So I'm deducting that 6,000 here. So I'm effectively then breaking up, I'm going to break up the 30,000 into my permanent differences and my temporary differences. Okay, and then my exempt portion on the capital sale gain on the sale of factory buildings. So my profit is in total is 200,000, but the capital gain will be the difference between my proceeds on sale, 1.12 million, less my original cost of 1 million. And again, 20% of that is exempt. Okay, so that's 24,000 that we are now deducting. Okay, so we're getting, first of all, getting rid of that 20% that I'm not going to be taxed on. Because at the end, the amount that we want here for our taxable income, we are going to take 100% of that and multiply it with 28%. Okay, so we want to get rid of everything that we cannot just go straight forward and multiply with 28%. Good. Then now for my temporary differences, remember that previously, what actually happened in year 2 when I did that revaluation, I already accounted for my value of my land to go up. And therefore I said, okay, because I'm messing with the carrying amount of land, now I've got this deferred tax amount. And I said, okay, but when I now realize that a land through sale, I'm going to have to pay tax on that, capital gains tax on that. So we've already accounted for that, that increase in the value of land. And so therefore that happened previously. So we now in the current year, we're selling that asset. And remember, we said that for land, we only included the 30,000 profit for accounting purposes. However, for tax purposes, we want the full capital gain. So that 60,000 is my temporary difference that I actually accounted for previously for accounting purposes, but now I have to include it for tax purposes. Okay, so the taxable portion of the capital gain recognized previously as a revaluation on land, that will be now my 250,000 carrying amount, less my original cost of 190,000, and 80% of that is my taxable portion. Okay, how much is that? So I add that now for land. 48,000. Good. And then for my factory buildings, now for the factory buildings, I have to eliminate my non-capital accounting profit. So we have already eliminated, we've dealt with our capital gains portion of the sale of sale of buildings. So we've dealt with that. Now we have to eliminate the rest of my accounting profit. So remember, for buildings, this full 200,000 was included in my my profit, my accounting profit. So we've now said there, okay, this 120,000 is the same as for tax purposes. The capital gain portion is the same for tax and for accounting. That difference between here and here and here and here is exactly the same. However, here we include 100%, here we include only 80%. So we fixed that. We've taken out the 20% that we don't want. Now we have to take out the remaining 80%. So that's what we're doing here with our factory buildings. We eliminate the remaining 80,000 accounting profit. And then we put in our capital gain, or or the recoupment of the buildings that we will be taxed on fully. So the recoupment, we said, will be the original cost of 1 million less the tax base on the date of sale. We taxed on the 100,000. Okay. So does that make sense? So this I have it. There is a little video on ClickUp explaining the capital gain on the sale of a depreciable asset. So you could go and have a look at that again. But the basic principle is just that I take my my total account profit, I break it up into my capital gain and my non-capital gain. And for the capital gain, I say, okay, at the moment we have 100% of that capital gain included in the profit. We only want 80%, so I have to take out 20%. And then for the rest, the non-capital gain, I have to take out 100% of that so that I can include my recoupment, which is going to be what I'm going to be taxed on. Okay, so this 80,000 was actually my previous, you'll see that this was my previous depreciation of all my prior years that I'm now deducting. And this is all my previous wear and tear allowances that I'm now taxed on, because I got it as a deduction previously, but now I'm taxed on. Okay, whereas for the land, the problem with the land now is that I only included in my accounting profit is only a portion of the full taxable amount. So therefore, I have to say, okay, on that portion of the taxable amount, or on that 250,000, the portion, that's just a portion. So for that portion, the 20% that I don't want has to be taken out. And then we have to put in the 80% of the portion that was recognized for accounting purposes in the previous. You got that? Good. Okay. Gets a little bit tricky, but it's not that bad. Okay. So I'm not going to do those journals, but I want to show you. So the journals, there's nothing weird or strange here. I'll just double check. Depreciation, revaluation, surplus. So maybe just journal 12, where we take the revaluation surplus to retained earnings. I saw there was a question on that in the group as well. So that will be at the net amount after tax. Good. So then, yeah, let's look at our deferred tax account. So remember, we had a deferred tax opening balance at the end of X2 of 19,040. Now, all our assets, we don't have any liabilities. We only had land and buildings. They are all gone now. They are sold. At the end of X3, they are not there anymore. So therefore, their carrying amounts will be zero. They won't have tax basis anymore. Nothing. My closing balance will be a zero. Okay, so the full movement there, the 19,040 movement, will go to my income tax expense. Okay, so the full movement goes to income tax expense. Yeah, so where's our income tax expense note? Let's quickly look at that. Okay, so main components of the income tax expense. Yeah, so for X3, there's my current tax that we calculated. Well, we didn't calculate it, but it's there in Calc 5. It was just the account profit. We didn't have any depreciation or wear and tear or anything. Oh, we did do the current tax. Yeah, sorry, I'm Democrat. So there's our current tax that we calculated. And then we have our 19,040 movement. So obviously, because in our deferred tax calc, we started with an opening balance liability. We want a closing balance of 0. So therefore, I had to do a journal of 19,040 debit. And the other leg goes to my income tax expense as a credit. So therefore, it's an income in my income tax expense. And then my reconciliation. Okay, so now the reconciliation we have to look at, because now we have things that is going to affect that reconciliation. Okay, so we start off with our accounting profit. We multiply that by 28%. That gives us 336,000. However, we have to reconcile to this amount. And remember, you get a mark, a balletjie, a bonus mark, just for showing that you know that these amounts should be the same. So why do we have this difference? So the reason why we have this difference is related to the capital gains tax, because remember, included in my accounting profit, we had that 30,000 gain for the sale of land, and the 100,000 sale of, or 200,000 gain on the sale of the buildings. However, we are taxed on the capital gains portion of that at only 80%. Good. So in my note, the reconciling items here is going to be, we had non-taxable items. So the non-taxable items will be that 20% that's exempt from tax. Remember, here we take the full amount, multiply by 28%, but 20% of my capital gains will actually be exempt. So the first one is the gain on the sale of land. So that was the 6,000. Where's that 6,000? Go find it here in my deferred. On my, yeah. Okay, so there's the 6,000 over here, which is then the difference, the 20% of my current year profit that I showed for accounting purposes. Okay, here's my note. Oh yeah, okay. So so it's going to be my capital gain on the sale of land. Okay, and that is that 6,000, which is the 20% more of the 30,000, and the tax on that is therefore a 1680 deduction, because I'm now actually paying less tax, because on that 20% I'm not paying tax. So that 60,000 is that the difference between the 280,000 selling price less the 250,000 carrying amount. That gives me the 30,000, but 20% of that is not taxable. And the tax on that 20%, the tax that I'm saving, multiplied by 28%, is the 1680. Okay, so the 30,000 was included in here, but that portion of that 30,000 is not taxable. And then the capital gain on the sale of the buildings, capital gain on sale of the buildings will be the 24,000 capital gain. So if we go back here, sale of buildings over here. Yeah. What's that now? Ah, there. So that 24,000 over there is the difference between my selling price and my original cost. 20% of that will be, I don't have to pay tax on that, so that's why I took out that 24%. So in my reconciliation, that 24,000 times 28%, I'm also do not have to pay tax on that. So that's why it goes into my reconciliation. And that gets us to our total income tax expense. Okay, so if you look at your current tax calc, the fact that we break it up between our temporary differences and our non-temporary differences, this makes it easier for us to do our recon, because we just go and have a look at, okay, which are these items that are not temporary differences, and these items will affect our tax rate reconciliation. Okay, these other items that are temporary differences, we've already accounted for that through deferred tax, so the movement will be included in my income tax expense. We fixed the tax so that's the same as accounting for these temporary differences, but for these ones we couldn't do it. Okay, what else can I show you on this example? We have a minute or two left. No, that's all. Oh, maybe just the transfer to the retained earnings in the statement of changes in equity. There you'll see it's the net amount of tax that we just transfer. Okay, I'm going to quickly check the online group for some questions. Will you upload your handwritten workings? Goodness gracious, if you can read anything, I'll see if I can do that. Okay, ma'am, can you please explain the CGT consequences under the temporary differences heading, the 80 and 100%? Okay, so that's now in the current tax calc, I assume. CGT consequences under the temporary differences heading. Okay, so here we said that in our for our land, we only included for 20x. The only amount that will be included in my accounting profit will be the 30,000. However, I am going to be taxed on the full gain on the sale of land. So if we look at our picture for land here, I'm going to be taxed for tax purposes on the full difference between the cost and the selling price. However, only this portion, only the 30,000 was recognized in profit or loss. So only the 30,000 is currently in that accounting profit, which is the starting point of my calculation of current tax. Good, so I still have to include this amount that I'm going to be taxed on. And that's now, and why it's a temporary difference is because remember when we did our revaluation in the prior year, we already accounted for that increase up to 250,000 and we accounted for the tax on that. However, now for tax purposes, we are only now going to pay that tax. So the temporary, why it's a temporary difference if we look at X2 versus X3 is for accounting purposes, we showed that gain in OCI between the 190 and the 250, so was that 60,000. We showed that gain in 20X2 for accounting purposes. However, only when we sell the asset are we going to be taxed on that portion. So in X3, for accounting purposes, we only showed the 30,000, but for tax purposes, we are now going to be taxed on the full 90,000 in X3. So can you see that this 60,000 gives me a temporary difference? Okay, even though it wasn't included in P&L, we've already accounted for the tax on that. And it's not included in my accounting profit, so therefore I have to add it. I have to add it over here in my temporary differences. Good. Why don't we include the 80% of taxable gains for the factory building? We are including it. We are including it. Remember, included here we have our 100%, and then we are deducting 20%. So effectively, we are including 80%. Okay. So if we take that 200,000 for the building, let's go back. Okay. If we take that 200,000 for the building, what we are effectively doing is we split that 200,000. Oh gosh, now I must remember. factory building. Yeah. We're splitting that 200,000 between the 120,000 capital gain and the 80,000 non-capital gain. Okay, so in our current tax calc, we start off with the 200,000, and then we're saying, okay, remember for the capital gain, 20% of that is not taxable. So we're deducting that amount here, and then so that's the non-temporary difference, and under our temporary difference, we take the non-capital amount, and we deduct the 20%, so that in the end we are left with the 80%. Okay. So here we are deducting the 20% related to the capital gain. And effectively, what we are here, we're deducting the full amount and putting in the 80%. But the effect is still, we could have just said plus 20%, which is then the plus 20,000, which is then the tax that I'm now being taxed on for the prior years. The benefit that I got in prior years that I'm now being taxed on now. Okay. See if I can put that in different words. Yeah. I'm to mekaar. Here I don't have the 20%. I'm taxed on the full 80,000. That's to mekaar. For the temporary differences, we tax on the full 100%. Okay, which is why I eliminate the accounting and putting in the recoupment. Sorry. Okay, is there a recoupment for land? No, there cannot be a recoupment for land because we didn't have any allowances. So we will only have a recoupment if we have allowances. We had allowances in the prior years, and now we're setting it for a higher value. Okay. I see the effect is the same. Looking at now, no. Must we mark our question 9 for IAS 12 before uploading it onto ClickUp? You shouldn't have the solution for question 9 yet. Do you have it? Okay. I think that will only be available after the due date for question 9. So please, do that question 9 question without a solution and upload that to ClickUp before tomorrow midnight. I think it's the due date for that. Good, and then you'll have the solution afterwards. Okay. Any questions from the floor? I'm going to try and make it more exciting for Thursday's lecture, because I know this was a lot of where you are, oh yes, just follow me. Question 9 solution is already available. Yes, then you have to mark it. Wasn't supposed to be available, but anyway, that's what Ms. Van As says. Then Mr. Duplessis says where, and then Mr. Iduwu says, because in question 9 there was a CGT calc like this one related to buildings that was very confusing. Yes, so there is a CGT. Of all your homework questions, it's actually only question 9. Oh, no. Okay, question 9 for IAS 12 has a CGT calc like the buildings. Okay, so that's in that question 9. Yes, for IAS 16 we don't have a question without solution, and there question 4 is actually the FRK 300 question that you have to look at. But all the others you also have to look at. Good, okay. That is why I was confused with how it was being calculated now. Okay, yes, so there are different ways of doing this current tax calc. So you have to find the way that works for you. So you'll also see in your notes in IAS 16 that there are, we provide you with an alternative. There are different ways to skin a cat, different ways to do this calc. So find whatever works for you. Okay, as long as you remember that we have the problem with our CGT is that that 20% that we're not taxed on is going to be a permanent difference, whereas the rest is actually just a temporary difference. I do prefer this way, thank you. Oh, I'm so glad. Okay, if you already uploaded question 9 without marking, is it fine? And I did, there was no solution. There wasn't supposed to be a solution, so okay, do whatever you want. If you want, if it's available, you can mark it if you want. If it's not, then just upload it. or otherwise just upload it. So, yeah. Okay. Yeah, that's all. Any other questions or issues? I'm going to get back to you about the class rates hopefully on Thursday. Tell you what the next process there is. What else can I tell you? Okay, so on Thursday we're starting with IFRS 16. So please go and check. I've already showed you the planning for the first 2 lectures of IFRS 16. We are starting off with revision of FRK 201 work, and then in Tuesday's lecture we will just add the FRK 300 on that for the lessee, and then on Thursday next week we'll start the lessor. Good. So please go and just have a look again at your FRK 201 work on the lessee, and then work through class example 1 in your notes, which is a revision example for the lessee. Good. Marathon session, feels like to me. Okay. Check you again on Thursday. Okay. Bye, online group. You guys won.